If you've been watching the news or scrolling YouTube lately, you think the Kelowna housing market is either on the verge of collapse or just one headline away from the next big crash. But that's not what's actually happening on the ground. What's really happening is far more interesting, and in my opinion, it's going to surprise a lot of people in 2026, especially if your outlook has been shaped by the doom and gloom headlines and clickbait YouTube content. Because here's the truth. Kelowna isn't one market, it's multiple markets moving in very different directions. And by the end of this video, I'm going to show you the one segment where I believe we'll see the steepest corrections and potentially the biggest opportunities for buyers who've been patiently waiting on the sidelines. And if you're new here, my name is Andrea Sereda, and I make videos about living in the Okanagan and Kelowna. And I'm also a top producing real estate agent right here in Kelowna. And my team and I help people just like you make the move to the Okanagan every single day. So let's jump in. But before I pull out this crystal ball and show you what I think 2026 is heading into, we need to rewind for a moment. We need to look back at what actually happened in 2025. Because when you understand how the market really performed last year, not the headlines, not the hype, everything about what's coming next starts to make a lot more sense. Let's start with one of the more headline-worthy segments from 2025, rentals. In 2025, rental inventory surged across the central Okanagan, especially in Kelowna. We saw over 2,000 purpose-built rental units come onto the market in Kelowna alone. Historically, Kelowna's had a chronic shortage of rentals, but the sheer volume of new purpose-built inventory changed the landscape fast. The main reason driving this flood of new rental inventory is federal government incentives, specifically the CMHC Select program, with highly incentivized developers to build more rentals. At the same time, 2025 also saw a flood of condos pushed onto the long-term rental market due to the city's short-term rental restrictions. Owners who could no longer operate Airbnbs were forced to pivot. While not all owners could stomach a loss by selling, many were forced to rent long-term, adding even more supply. Because of that combination, vacancy rates moved fast. What was near zero vacancy in prior years jumped to over 6% in a single year. That shift was dramatic, with ripple effects throughout the market, especially for investors and condo owners, which helps explain why some of the pressure we saw in certain segments of 2025. So now let's look at the property sales sector. Overall, in 2025, the central Okanagan market softened. Some price points faced downward pressure, but when you zoom out and look at the overall benchmark price, it really stayed relatively flat. This was not a crash, it was normalization after the extreme pandemic run-up. Now let's break it down by property type. For single-family detached homes, prices were down about 2.1% from last year, and roughly 15.9% from the peak in 2022. Now that sounds dramatic until you remember how aggressive prices went with growth leading into that peak. Condos tell a more nuanced story. On the surface, the condo benchmark price was actually up around 3% year over year and down about 11.6% from the peak of 2022. So if you look only at the general resale condo market, 2025 really wasn't that bad. But that's not the condo market that you've been hearing about in the headlines. The segment that's been making the news is new construction. This year, we saw a large wave of newly completed condo buildings coming online. They were pre-sold at the height of the market frenzy. Developments like Aqua, Movala, Water Street by the Park, and Caban all took completion in 2025. Many of these units were purchased at prices of $1,000 per square foot or more at the peak of the market. Some purchased with hopes and dreams of using these units for vacation rentals and earning some extra income while being able to carve out some time to use them themselves from time to time. Some purchased these to live in, and some purchased on speculation, with the expectation that prices would surge and owners could cash out. Well, that didn't happen. Shortly after these projects had record-breaking sellouts, we saw interest rates aggressively rise, and prices pulled back quick and fast. Fast forward to 2025, when these buildings completed and it was time to close on their purchase, the market was very different. In some cases, depending on the timing and price of units, we have seen prices fall upwards of 20 to 30%. Owners who need to sell in some of these buildings today are facing six-figure price hits in a lot of cases. This is the pain you're reading about, and that is real. But it's also very important to understand that this is one specific slice of the condo market, not the entire condo ecosystem. So when you zoom out beyond new developments and look at the broader resale condo market, 2025 was a much more balanced than the headlines suggest. If we look at total sales volume in Kelowna per our local real estate board, for 2025, we saw an increase of just over 7% and a slight increase of average days on market from 57 to 63. Now, one thing to keep in mind when you hear days on market stats is that number can be misleading. Days on market resets when a home is taken off the market and relisted at a new price. So the true time it takes to sell a property is often longer than what's reported. What this number really tells us is that homes priced correctly for the current market are still selling within about 60 days. That's not a broken market, that's a market demanding realistic pricing. Now, with that context in mind, let's take out my trusty crystal ball and talk about what I believe 2026 will hold. Now, before I dive into my predictions and zoom back into Kelowna, it's important to take a step back and look at what credible sources are saying about Canada as a whole, because local markets don't move in isolation. At a national level, the big takeaway for 2026 predictions is this: no boom, no bust. Organizations like the Canadian Real Estate Association are forecasting that home sales across Canada actually begin to slightly rebound in 2026, with activity levels reaching their highest point since 2021. Now, that doesn't mean we're heading back into a frenzy. It means that the market is expected to thaw, not explode. CREA is also forecasting modest national price growth of roughly 3%. Reinforcing the idea of a market that's stabilizing and finding its footing rather than racing ahead. So when you factor in inflation, that growth is effectively flat. At the same time, the Canadian Mortgage and Housing Corporation has been very clear that affordability remains the biggest constraint facing the housing market. CMHC expects that after a softer 2025, housing conditions will begin to stabilize and gradually recover in 2026, but not in a way that suddenly makes housing cheap or easy. In other words, demand doesn't disappear, it just becomes more selective and more price sensitive. Interest rates are another big piece of the puzzle. The Bank of Canada has signaled that rates will likely remain relatively steady heading into 2026. That gives buyers more certainty, but it doesn't mean we're going back to ultra-low borrowing costs. So when you put this all together, modest sales recovery, modest price growth, steady rates, and ongoing affordability challenges, what you get is a very rational national housing environment. And this is important because when people hear that prices aren't exploding, they often assume that means a crash is coming. But that's not what the data suggests. What the data suggests is a market that's calmer, more balanced, a far more dependent and local supply and demand dynamics. And that's where Kelowna's story starts to really diverge, as Kelowna is not only driven by national data. Being boots on the ground here, one thing I can tell you with confidence is that we're seeing steady migration into the Okanagan. Retirees continue to move here for lifestyle. Dual citizens from the United States are choosing Kelowna. And buyers from higher price markets like Ontario and the Lower Mainland, they're relocating for a combination of lifestyle, relative affordability compared to where they're coming from, and simply to get out of crowded major cities. Another factor that's at play is the wave of baby boomers that are starting to retire. Something to take into consideration with this, especially in Kelowna, is that many of the baby boomers are sitting on large amounts of equity in their paid off homes, and they're not affected by higher interest rates, and they're still moving ahead with their retirement plans. So when you look at Canada as a whole, there's still a lot of retirees who have the Okanagan on their radar to retire to. I mean, where else do you get milder climates, access to all the beautiful lakes and nature, all while having access to an international airport and strong healthcare facilities? Especially with everything going on down south of the border, we are hearing more and more from people every week charting out their next steps of retiring in Kelowna or other parts of the Okanagan. that steady demand matters. And it's one of the key reasons Kelowna behaves differently than many other Canadian markets. Now let's look at different parts of the real estate market, as it's critical to understand that Kelowna is not one housing market. It's a collection of different ecosystems moving in different speeds. Let's start with single-family detached homes. This might be an unpopular opinion, especially if you've been consuming a lot of doom and gloom content, but spoiler alert, negative news gets more attention. It gets more clicks than good news. So let's move past the clickbait and talk reality. When I look at the detached home market in the Okanagan relative to demand, I believe long-term we have a shortage of single-family homes. Over the last 5+ years, the vast majority of new construction homes have been condos. We are simply building fewer detached homes, and the ones that are being built are no longer affordable for a large portion of our market. Just this morning, I did a quick search of new construction detached homes built in the last couple of years across Kelowna. The cheapest one available is $1,085,000. And that gets you about 1,800 square feet, 3 beds, 3 baths, on a strata lot with roughly $200 per month in strata fees. The next cheapest detached new construction home available was $1,229,000. While the cost of land, materials, labor, city fees, it's simply not possible to build affordable detached homes anymore. So because of that, I strongly believe demand will continue to outpace supply in this segment, especially in the next decade in the Okanagan. My prediction for 2026 is that detached home prices remain relatively flat, with the potential for slight appreciation that keeps pace with inflation. Now, once you step outside of single-family homes, the story changes again. Across most major Canadian markets, including Kelowna, we have a growing issue known as the missing middle. There is not enough housing between starter condo and larger detached homes where families can have some space, maybe even a bit of a yard without the hefty price tag of a detached home. And this is where the townhouse market becomes incredibly important. When we look at the townhouse market, the data tells a very steady story. In 2025, we saw almost the exact same sales volume as the year before, which in itself is notable given how much noise there's been around the broader housing market. This segment held up well. Prices moved very modestly, and the median townhouse price increased slightly from about $670,000 in 2024 to roughly $680,000 in 2025. That's not a spike, it's stability. And that stability is important because it tells us that townhouses are sitting in a very practical, functional part of the market. Looking ahead to 2026, my expectation is that sales volume edges slightly higher. The reason isn't speculation, it's necessity. We're already seeing more move-up buyers coming out of the condo market. These are buyers who still want ownership. They still want some outdoor space, maybe a garage, and something that feels more like a home, but who are priced out of detached properties. At the same time, townhomes remain one of the few options that actually work for families from an affordability standpoint. With detached homes increasingly unattainable, townhouses naturally become that next step. And because of that, I believe 2026 will likely be another relatively flat year for townhouse prices, similar to what we saw in 2025. Not a boom, not a pullback, just steady absorption and balanced conditions. And in a market like Kelowna, that kind of stability is often a sign of strength, not weakness. Now let's move into what's really been the showstopper of this cycle, and that's the condo market. And the most important thing I can say before we go any further than this is that the condo market is not one thing. To make sense of what's actually happening and what I believe 2026 will look like, we need to break this into 3 very different segments because each one is behaving differently right now. First, I'll talk about general resale condos. These are condos built prior to 2020 that make up the bulk of our everyday resale inventory. Second, we'll look at buildings that were specifically constructed and zoned for short-term rentals because policy changes have had a massive impact on this segment and could shape what happens next. And finally, I'll dive into new construction condos, the buildings that completed over the last couple of years that were largely pre-sold at the peak of the market and are the source of most of the negative headlines you've been seeing. Once you understand how different these three segments are, the condo market in Kelowna suddenly makes a lot more sense, and so does my outlook for 2026. So let's start with general resale condos. These are condos built prior to 2020. This is the largest and most stable portion of the condo inventory in Kelowna. Despite all the negative headlines, this part of the market actually held up reasonably well in 2025. We saw steady absorption, livable floor plans still attracting end users, and pricing that was relatively stable when compared to the peak. These condos tend to be more affordable on a price per square foot basis, less investor heavy, and more functional for full-time living. And because of that, I expect the general resale condo market in 2026 to remain relatively stable. Not a boom, but not a collapse either. Pricing may drift slightly, but well-located, well-managed buildings should continue to transact, especially for buyers who want ownership and aren't chasing short-term returns. Second, buildings that are designed and zoned specifically for short-term rentals. Now, this segment has been impacted far more by policy than by demand. If the city's application to the province to loosen short-term rental restrictions for those purpose-built buildings is approved, I don't believe we'll see investor confidence coming rushing back overnight. Many investors were burned by the abrupt policy changes in the past, and because of that, I expect a much more cautious response this time around. What I do believe we'll see is stabilization. Prices in many of these buildings have already pulled back by multiple double-digit percentages, and if short-term rentals are allowed again, I think a large number of those owners will simply take their units off the resale market and put them back into short-term rental pools, rather than selling at today's prices. That reduction in resale inventory alone could help stabilize values. And over time, as confidence slowly rebuilds, it could create modest upwards pressure as prices recover. On the flip side, if short-term rental restrictions remain in place for those purpose-built buildings, I expect continued downward pressure. Without the ability to operate short-term rentals, many of these units struggle to pencil out as long-term rentals given today's carrying costs, which keeps sellers motivated and prices under pressure. So for this segment, 2026 really comes down to policy, not demand. The decision doesn't flip a switch back into a hot market, but it does determine whether prices find a floor or continue to drift lower. Now, the third segment, and the one driving most of the headlines, new construction condos. These are buildings completed over the last couple of years that were largely pre-sold in the height of the market. Many of these units were purchased at the peak pricing, often above $1,000 per square foot, with the expectation that prices would continue to rise. Instead, these buildings are coming on the market in a very different environment. Interest rates are higher than buyers originally anticipated. Rental conditions have softened, and investor returns have evaporated. Because of that, this is the segment under the most pressure. And in my opinion, it's also the segment where you will likely see the steepest price declines in 2026. Owners in these buildings are being forced into some very difficult decisions. Option one is to hold and wait for prices to rebound. And while prices may recover over time, some forecasts suggest that that could take many years, potentially even a decade, depending on the building and the broader market cycle. The challenge with that strategy is simple. Cash flow isn't really on the table in today's prices. With the surge in rental inventory, many of these units don't even rent enough to cover current mortgage payments, strata fees, and carrying costs. For owners with financing in place, that often means a monthly shortfall just to hold on to it. Option two is to sell at today's market prices. And for many owners, that means taking a six-figure loss simply to exit. And that's exactly why this segment is dominating headlines right now. It aligns with what you've probably seen described as can't rent, can't hold, can't keep situations. For sellers who bought in the peak, this is painful. There's no sugarcoating that. But this is also the segment where pricing is being forced to reset to reality. And that's why I believe we'll continue to see pressure here until values fully reflect today's market conditions. And this is where the conversation naturally connects back to the development land. Because what happens in the condo market and what happens to development land are deeply connected. Looking ahead to 2026, my expectation is that development land priced in line with today's market realities will begin to trade again. We've already seen that when sellers adjust to current condition, there's still real demand, especially for well-located sites with clear development potential that actually pencils out. That said, there's still a large amount of development land being priced as if it was 2021 or 2022. Those properties have largely been sitting, in many cases, for 2 years or more with little to no activity. As we move through 2026, I believe that gap will become even more obvious. Sellers who adapt and price in today's environment will transact. Those who remain anchored to peak era pricing will continue to sit on the market as they have over the past couple of years. And this is where I think a big opportunity exists. For buyers who are looking to hold long term, some of the best buying opportunities we'll see in the local market for quite some time may actually be homes sitting on development potential land. These types of properties have already gone through significant price corrections, and while the development upside may not be immediate, the long-term fundamentals are still really strong. Over time, as market conditions normalize and development economics improve, these holding properties are likely to recover in value, and in many cases benefit from future densification. In this phase of the cycle, land doesn't trade on optimism or headlines. It trades when the numbers make sense and when buyers have the patience to look beyond short term. So when people ask whether Kelowna is heading for a crash or another boom, my answer is simple: neither. What we're really seeing is a segmented reset. Some parts of the market are stable, some are under real pressure, and some are quietly setting up for the next opportunity cycle. That's why the key in 2026 isn't trying to perfectly time the market. It's understanding which segment you're in and making decisions based on reality, not headlines. For buyers, especially those who've been waiting on the sidelines, this is the type of market where preparation and patience can really pay off. The best opportunities don't show up on every listing, and they don't come in a big flashing sign that says, "This is the bottom." There is no clean way to time the market. By the time it feels obvious or safe, it's usually already in the rearview mirror. The buyers who tend to do the best are the ones who understand which segments are correcting, know which sellers are motivated, and focus on properties that actually make sense long term, rather than chasing headlines or trying to guess that perfect moment. The next phase isn't about rushing. It's about acting thoughtfully while the market is still finding its footing. And for sellers, this is no longer a market where pricing based on hope or yesterday's numbers work. Strategy, positioning, and timing matter more than ever. The homes that sell are the ones aligned with today's reality, not the peak. And that's exactly why working with a seasoned real estate agent who truly has a pulse on the market makes all the difference. And if you're thinking about buying or selling, or even just trying to understand how this all applies to your specific situation, I'm always happy to have a real conversation and help map out the smartest next move. My contact information is linked below. Feel free to call, text, or email anytime. And if you have found this video helpful, give it a like, subscribe, drop a comment, and I'll see you in the next video.